Hi, everyone, and welcome to our March 2026 podcast. Glad to have you here. My name is Carly Purcell. I'm joined today with
Ryan Schuffer.
Derek Van Solkema.
How's everyone doing?
Yeah, good. Can't believe we're through March already.
I know.
That's
insane.
It's wild. So we're anticipating what? I mean, the big one for us at work is tax season here. It gets pretty darn busy in April. So
It does.
yeah, Carly, you field a lot of calls.
We do.
What are some of the biggest questions you get typically?
Biggest one probably is, where are my tax returns?
The tax forms, right? The tax forms.
Oh, shoot.
Yeah,
Yes.
that's right.
Sorry, forms.
Yeah. Right. It all kind of goes into the return, but that's always something that we're trying to track down. Sometimes you get them electronically and you don't even realize it. You know, sometimes we get the call, hey, I never got my tax form. Well, did you check your email? Type of thing. But the beauty of it is, Carly's here to help. There's plenty of people here to help. Just reach out to us if you have an issue. Spring break's another thing that jumps out at you in April. So, I mean, we'll
No plans.
No plans?
No plans.
plans.
We're gonna head south and finally get to some warmer weather. So
There you go. I mean,
Looking
it's been a rough end to the winter here in the Midwest. It's always volatile in the springtime when it comes to the weather in the Midwest. And guess what? A lot of times we get market volatility in the springtime in the stock market. Volatility is just deviations that are larger than normal. Deviations from what? What you might consider normal. That's volatility. So whether we're talking about temperatures outside or values in the market, it all flows through, right?
It does.
Yeah. So anyway, what did you think of the market in March? Or you're going to make me answer that?
Yeah,
one,
I
aren't you?
am.
Okay, yeah.
Let's get into the market up.
Yeah, let's jump in. So basically, March was a tough month. And we kind of saw that setting up as we wound down February. But you know, the S&P 500, top 500 companies in the U.S. as measured by market capitalization, so size, was down almost 5%, 4.98% for the month of March. It's been a while since we've had a decently large drawdown in a single month. So bonds were not immune to the volatility either. You know, we like to look at the aggregate bond index, just a basket of bonds. It's down 1.76% for the month of March. So challenging on all levels of the portfolio. But inside of that portfolio, we're always focused on what needs to be there to try to give our client base an edge. And that edge is the outperformance, the alpha that we try and generate. So, I mean, Carly, you kind of saw some transactions come through, not a whole lot.
No, not a whole lot for March.
But when you look at what were we doing in March, we were just reshuffling around some of the fixed income portion of the portfolio, so that bond section of the portfolio. Remember, we've talked about interest rates stabilizing a little bit and kind of trending more. That allows us to be a little bit more tactical, I think, in that fixed income space. So we're wading into that, and you might have seen some transactions come across the board on your particular portfolio. So, you know, we're happy to do that, happy to lean into the turns. But as I talk about that basing and kind of trending of interest rates and allowing us to maybe see some tactical opportunities. Well, we had an event kind of playing out in March that made that a volatile space in the interest rate world. And so, I mean, Derek,
we'll kind of jump into it, right? I mean, I think the everybody knows there's a war or a conflict in Iran, and those shocks kind of echoed through all of the markets, not only in stocks, but also in the bond space.
Yeah.
Right. So we saw a big oil spike there, but let's kind of just, let's
unpack. Yeah, let's unpack
that first.
Right, with Iran. And so anytime you run into one of these conflicts, and again, it's crazy. I consider myself a young guy, but I look around and there's so much younger now at Advanced Capital and just in this space. I've been watching this stuff for 20 years. And, you know, it allows you to see a lot, and if you're paying attention in inventorying, you know, behavior and whatnot, and what plays out in certain market environments as it relates to a shock. Remember, we're here to talk about the markets, not politics, not your feelings or anything like that. I hate to say it, not that they don't matter to us, but what we're here to focus on is your investments with us. So let's think about it. Conflict with Iran. You immediately have to check down what gets disrupted in the disruption of the relationship. And you would say, well, what are they a big trade partner with us, the U.S.? Are they a big trade partner with other countries in the world? You have to recognize that that disruption will impact things, but what's it going to impact? And so with Iran, it's oil. It's oil. Even if we don't get the majority of our oil from that particular country, it's all a global supply. Any global supply disruption even. In fact, perhaps you've now been made aware there are really two prices of oil that we watch in the world. You've got WTI, West Texas Intermediate, and you've got Brent crude, which is different, Brent crude. And characteristically speaking, there is a difference. I'm no expert there, so I'm not even going to try to pretend that I know. But Brent crude is typically consumed in Europe and other countries. We do a lot with the WTI. So we would watch West Texas Intermediate, somebody in over Europe, probably looking at Brent crude. But the bottom line is it's all one global supply. So anytime there's a supply disruption, you're going to have price movement. Now, Derek, I know where you were taking this one, right?
Yeah.
Oil. It's a big part of the global economy. Goes into everything, quite frankly.
Goes into everything, and I think what our clients see most is probably right at the pump, like most Americans are seeing a big shock there.
Right.
Prices there are up over $1 a gallon. We're all feeling the pain at the pump. How long is that going to last? And again, those inflationary pressures, are not only impacting the global markets, but here at home with us.
That's the big one. What price of oil is a big input in inflation calculations. So you get these spikes, inflation is going to be maybe briefly elevated, but one way or the other, guess what tries to go attack inflation? Interest rates. That's where you're getting the volatility in the interest rate world. And remember, we talked about the bond market had a rough month in March. It can be described by that. So when you think about the context here, if you can point to something and describe it, I hate to sound like this, but it's almost an easier problem to tackle. The really challenging problems are the ones that it's really kind of tough to figure out how you're going to solve that problem. Okay, but when you think about oil, not only do we see paying more at the pump acts like an extra tax, less discretionary consumption, could perhaps impede corporate earnings, but just think about the plastic container that an object would come in. That plastic is a petroleum product. The lipstick or the lip gloss you might put on, or the chapstick you might put. Oil finds its way into literally almost everything. That's why it's so important from that inflation standpoint. And that's where you're seeing some of the volatility there. But again, we can deduce down the impact or the potential impact of this conflict by really just looking at the relationship that Iran poses on the global economy. And the biggest issue is the oil.
Yeah. Well, as we're seeing this rise in geopolitical events and risks, almost a two-part question. Like, how is that, interacting with some of the structural risks that are out there, and then how would that maybe combined impact our clients?
Right. So what you're thinking about here is two types of risks to a portfolio, and we wanted to just unpack this in conversation with everyone. Geopolitical events and risks, and again, feel free to push back, and I get it. My description here is going to be very top level, very high level, but geopolitical risks and events, you can typically point to what looks like a solution or an off-ramp. Oftentimes, it's going to be an individual or a group of individuals making a decision on whether it's a trade agreement, whether it's a ceasefire agreement, whatever it is, these geopolitical risks and events, they typically can be wound down, de-escalated pretty constructively. You can point to what looks like a solution. The structural problems that we may approach in the markets, in portfolios, those are harder. Those ones might require a more tactical approach in a portfolio. Because the geopolitical things can burn off rather quick, you almost can't be doing a whole lot in that short term because you might very well miss a return to something that looks more normal. It could be a very explosive turn to something that looks more normal. And there's no amount of economic, market data that we can look at to try to get inside the head of a decision maker or a group of decision makers. So when it comes to these geopolitical events and risks, you have to, of course, understand if they start to unravel into something more structural, well, then we got a different type of problem. But on balance, you approach it with your long-term lens and navigate through that volatility. The structural things require changing some dials. So what might the structural things look like? Well, one of the ones that we've touched on this year already, but it's we're gonna continue to look at into the year. But the change at the Federal Reserve. So Jerome Powell will be replaced by Kevin Warsh. His first meeting will be June, mid-June. And so what happens there with Fed policy, monetary policy? Those are structural issues. They're going to require a different approach to your money as it relates to those headlines, and there will be headlines about it. So there are two distinct differences on how we handle risks and events. But as we muddle through this problem in the Middle East with Iran, just recognize that's the way we're approaching it right now.
Yeah. Well, and we've seen within the Trump administration, a tweet or a Truth Social post can move markets by 300 basis or 3% or 300 basis points in a day, just like that. And so, like you said, if you're not staying consistent or you're trying to make moves based off of what these geopolitical events or headlines are, you can very well miss very quickly. And so sometimes staying the course is the right course of action.
What you're saying is don't get cute.
We don't need to get cute.
No.
And that's the beauty of it. We're long-term focused and but with that, we've kind of tapped on the geopolitical risks, structural issues, or risks and events. What about just normal market behavior?
Yeah. This is always the one I like to kind of trot out because, yet again, I talked about, I'm the old guy now, which is just mind-blowing. But one way or the other, I've seen a lot, and you kind of see that markets need to be volatile. They need to be volatile to be normal, right? You typically get a 10% drawdown if you're looking at the S&P 500, and depending on what time frame you're going for, but let's just say it happens about once every 2 years. It's going to happen. I don't care what the headline is going to be. It's going to happen. And so right now, okay, the catalyst, we can all point to it. It's the conflict with Iran, war with Iran. That's what it is. But the market volatility is very normal. And if there was a lack of it, that would be more concerning to me. So we're getting it. But it's part of the ride, it's part of our journey. And that's why you've got to focus on what the market is in the short term and in the long term. In the short term, it's a very volatile place, it's inefficient. There's a lot of different factors that you might not even be thinking about that are going to impact that day-to-day, very short term. Longer term, we make good business decisions, we should have success. So again, normal market movement. Markets are volatile.
Wall Street climbs a wall of worry.
Yeah.
Right? There's always been a reason not to invest.
Yeah.
And again, those who have stayed the course.
Yeah. So you've just trotted out a Warren Buffett quote, which is great. So Wall Street climbs a wall of worry. And then here's my quote. I'll add to it. If there was nothing to worry about, that would be the worry itself. So again,
I'll start adding that to my
that
the
would be the
quote
worry.
there.
But
that
is
is.
right.
Yeah, it is. And as we kind of look ahead into the month of April, we've got some client luncheons coming up that we're excited about seeing everybody out in person again.
Absolutely.
But just as far as client's perspective, what are we kind of looking at as we look out?
Well, as we enter this phase, recognize we got a lot of this volatility out of the way. Seasonally speaking, the spring markets really do lend itself to volatility. We got it. If we go through kind of these healthy flushes, that sets up for, I think, some opportunity as we enter into the summer months and what have you. But clearly, geopolitical risks are not gone. We do have changing of the guard at the Fed, and later on in the year we'll have midterms. But again, I think we can get a little bit constructive for the next couple months here, and I think we've notched the portfolios where we need to. So don't be prepared for a bunch of big changes, and we'll look forward to seeing you at our client luncheons in the month of April, but certainly in this venue again for the month of April. Thank you so much. Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thanks for tuning in. We'll see you next month.